Hey, Steve Saretsky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask you to hit thumbs up and subscribe. Questions, comments, put those below. The latest edition of the Saretsky Report for July 2020 is now out. Again, that's an in-depth analysis on the Vancouver housing market. So if you kind of want to figure out what's going on in written format and all the charts and the graphs, it's a 25 page PDF. So there's going to be a link in the description below where you can get that report for free. Again, the big emphasis here is free. I've been so inspired by a lot of the financial content that I've read over the years, particularly Real Vision, Hedgeye, etc. So I've really kind of tried to incorporate that into the housing market, into something that I am knee deep in on an everyday basis. So hopefully that brings some value to you guys. But I wanted to give a kind of a brief overview of kind of the Vancouver housing market, for example. Really just seeing a huge rebound in sales here in July. Again, basically you had your spring market basically move into the summer months, so July, which is typically a slower month, saw a huge rebound in activity. So July, so year to date, so January through July, so July had the most sales thus far in any given month and the most new listings in any given month. So just an immense amount of activity happening in July. So pretty crazy month for those in the real estate industry. And I think what, again, we're seeing this shift, this flight to larger spaces, people selling the downtown condo, prices coming down right now for downtown condo. If you're looking for a downtown condo, you can probably get a 10% discount today, as everybody feels they no longer have to go to the office. They're selling that downtown small condo space and moving out to the suburbs to get a single family home, and we're seeing those single family house prices actually move higher. If you're looking for a single family house in Greater Vancouver, sub $2 million, there is, as you'll see in this chart, there's 2.6 months of supply available for sale. So it's a very, very tight market. Obviously, when you get sub 3 months of inventory, that's going to start to push prices up. And that's what we've actually, ironically, amazingly seen, that prices in the detached housing segment, for the most part, are higher today than they were pre-COVID. So I think, again, this kind of comes back to liquidity driving markets, which I think is the real benefactor here, is liquidity driving markets, ultra low mortgage rates. We're right now seeing they've actually just come off again. You can actually get a 5-year fix today from one of the big 5 Canadian banks at what, about 1.9% on a 5-year fixed mortgage rate, uninsured, about 1.9%. So that is driving the markets, along with the massive amounts of liquidity, which we're going to get into here, because I want to highlight something that I think this is, I just found it kind of funny. Pierre Poilievre, the conservative guy MP who's been out lamenting Justin Trudeau and all these politicians, and has been very vocal on social media, tweets an article from the Globe and Mail. It says, the article is titled, "The Bank of Canada Keeps Making the Rich Richer." And Pierre Poilievre comments, "Printing money inflates the financial assets of the rich while reducing the purchasing power of the working class. The sooner this stops, the better." Well, unfortunately, I have news for you, Pierre, and I'm sure he knows better. This isn't going to stop, and it's not going to stop anytime soon. In fact, it's going to get incrementally worse, because these guys are so far in it, there really is no escape valve at this point. This is a chart of the Bank of Canada's balance sheet. It has grown nearly 500% now since the pandemic. For example, everybody's talking about the Fed's money printing. In the US, their balance sheet has only grown by about 100%. So the amount of intervention coming out of Canada on the monetary policy side and on the fiscal side has been gargantuan. And that has really been what's really ultimately suppressed free markets. Free markets from allowing housing markets to stutter and to naturally correct. This is again going to create more and more wealth inequality. Unfortunately, because there's so much debt in the system, you actually can't allow rates to normalize, because people always say, well, just let rates normalize, because households that over leverage themselves in real estate, they should be paying the consequences for these decisions, and it's not our fault that you took on too much debt, so we should just raise interest rates, crush houses and house prices, get back some levels of affordability. But what people are failing to misunderstand, and I think that logically I understand that the moral argument there, I actually totally agree with it, but the reality is that interest rates, by even raising interest rates somewhat, even normalizing them, but let's say they push rates up by 1%, the actual federal government would actually be bankrupt, and so would all the corporations. So the whole system essentially collapses in on itself. So if you can start to understand these underlying dynamics, it really starts to put the whole picture together of exactly where we are in today's environment. And I'm going to bring you to now understanding that and understanding what central banks are doing. It brings you around to the whole thesis, which is in the news this past week. The Bank of Ireland, the Central Bank of Ireland, announced that they're now going to begin imposing negative interest rate policy, negative interest rates on savings held by pension funds in the financial system. So basically what this means, if you're a pension fund, you are no longer able to hold cash. If you hold cash, you will be charged a negative interest rate on that cash. So you are paying to sort of money. So not only is inflation running at, let's say, 1.5–2%, arguably higher, because those metrics, these central bank CPI type metrics are bogus to begin with. So not only is inflation running at 2%, but that cash is now being charged negative interest rates. So you're basically just being absolutely punished to hold cash, and this is going to force these sort of pension funds, for example, into government bonds, because they're mandated to hold a certain allocation to government bonds. Again, these government bonds are yielding sub 1%, basically yielding 0%. And then the rest of their allocation is forced, again, into riskier assets, such as stocks, alternative investments, such as real estate, private equity. So it's forcing these type of pension funds, savers, etc., into more and more risky assets, and that's why you continue to see this massive asset price inflation. You ask about why people wonder why the stock market's rebounding, for example. Given the economic calamity, all these businesses, the revenues are down. The revenues are going to be down for the foreseeable future. Terrible economic environment, yet stocks push higher, totally disconnected from the real economy. Again, it's because of these dynamics, because you impose negative interest rates, because you have essentially decimated the entire bond market, that again, we're creating more and more of this risk-taking environment. You're pushing people into these types of activities, and I think again you can apply this into our situation here in Canada, where again, if you create an environment where, for example, you push interest rates to the floor, you buy up Canada mortgage bonds, you lower rates, you talk down the market, you come out and tell Canadians that interest rates are going to be low for the foreseeable future. They don't have to worry about it if they're going to go and borrow a house. You're incentivizing, you're telling Canadians, for example, what to do. And when Canadians see house prices not falling during an economic recession, as the worst that we've seen since World War II, and a global pandemic, not able to squish real estate, and in fact in some segments prices moving higher, it actually creates this self-fulfilling feedback loop where you're reinvigorating to people, you're reminding people that house prices cannot come down. It's almost as if they are mandated to rise. And this is, coming to this centrally planned economy, almost like a communist Chinese government type mandate, where the government essentially mandates house prices to rise. And so I think we're creating very, very perverse behavior, but unfortunately that's what the system is. And again, you can fight it, but realistically, you can't really change it. I suspect that society will change it through again, as I've talked about this many, many times, through massive amounts of social unrest. We're going to see more and more of these fringe politics. And I think this is really just the beginning of this wealth divide that continues to expand at an unprecedented pace. So that's all I have for this week. I highly encourage you to check out my in-depth report there. That's going to give you the full breakdown on the Vancouver housing market if you want to get my thoughts in more detail on that. But in terms of the big picture, that's what we'll continue to focus on every single week right here. So subscribe, thumbs up. I'll see you next week.